We've seen some really interesting moves in gold over the course of the last few weeks in a manner that's been very different from what we've seen in the yellow metal for quite a long period of time. Obviously, events in Israel and Gaza have contributed towards the movements that we've seen in financial markets over the course of the last couple of weeks. And we've seen a lot of safe haven appeal for gold, meaning that it has rallied at a time when the dollar's performed well and when bond yields have been rising. Again, that's not a trend that we have seen over the course of the last few years, and therefore would suggest that we're just seeing a lot more risk aversion in the markets and a lot more moves towards those traditional safe havens, of which gold very much stands out. It's going to be interesting to see if that continues over the coming weeks or months, especially when we are seeing such significant moves in bond yields at the same time. Whether we're looking at the US or Europe or elsewhere, we have seen bond yields rising at quite a pace. And that comes despite the fact that we have seen Fed officials naturally talking down the prospect of many more rate hikes, moving away from the message that they were seeing before when bond yields were quite calm, and instead talking simply about the need to maintain high yields for longer rather than necessary raising further over the coming meetings. So we've seen much higher yields in bond markets, but we have seen much higher gold prices as well. And again, the question for many traders will be, is that sustainable? Well, let's take a look at the charts and see what they say. So what we have here is a gold daily chart. And as you can see, over the course of the last 2 weeks, we have seen a strong move in gold from close to $1,800 to around $1,950 where we're trading currently. Now, there's a few things we need to point out that we've broken in this move that has been quite bullish. The first is that descending trend line from the highs back in May. You can see it touched here on a number of occasions, briefly broke above in September, but has significantly broke above, particularly on that day that we saw on Friday the 13th. In that time, we've also broken through the 55-89 day simple moving average band and the 200-233 day simple moving average band, which is quite significant considering how long it took to move back below that band here. Obviously, so it tested back in February and again on a few occasions then in August, September, October, and then we finally saw it break below. We've broken back above there, which I think is quite significant under the circumstances, even if it is driven by potentially temporary risk aversion in the markets and the move, as I said earlier, towards those safe havens. The interesting tests now actually lie around 1970, 1980 potentially. And the reason why I highlight those two levels is that this is where we've got the 61.8 Fibonacci retracement level. So that should give us some indication, at least. Of course, this is still being driven by news flow, but from a technical perspective, that could give us some indication as to whether we are seeing a corrective retracement or something more significant, maybe a more bullish move to the upside, because we are deemed to be in a much more risk-averse environment for a much more sustained period of time. The other area, 1980. Now, the reason why I highlight that is because we have seen on a number of occasions that's acted as a key area of support and resistance, just shy of that 2000, which is obviously the big psychological level. But you can see here that we saw plenty of resistance. You can also see in this period here as well, and also support back around this period also. So 1980 probably stands out as an interesting area of support and resistance previously, and therefore a potential key level on approach to what is going to attract far more attention, which is the psychologically significant $2,000 zone. But of course, a lot of this is going to be ultimately driven by the news flow and how risk averse we continue to see markets trade. We may see some indication as to whether we are starting to see that weaken from the momentum indicators. So you've got the MACD at the bottom, both moving averages pointing higher, and the histogram too. So that's supporting price action, and also the stochastic just above. And again, that is continuing to edge higher, maybe perhaps flatline. The 4-hour chart may give us some further indication, perhaps some further signs of divergence actually on the 4-hour chart. So potentially suggesting in the near term, we are seeing a little bit of weakness appear in that uptrend. But I think 1970, 1980 is going to be really crucial. That negative divergence may suggest we are seeing some weakening of the trend, but in itself, it's not a bearish indicator. It acts more as a red flag. So we can continue to see prices going higher at a time when we are seeing increasing divergence. But on the daily chart, both of those momentum indicators still look relatively healthy. No clear divergence on the daily chart. We're only really seeing that form on the lower time frame on that 4-hour chart. So I think the news flow is going to be key here, and whether we continue to see a lot more risk aversion in those broader markets. And I think it's safe to say that today we are still seeing plenty of risk aversion, and the headlines are continuing to be a driving force of how financial markets are ultimately trading.